The CEO of Barclays Europe has weighed in on Europe's economic attractiveness amid concerns over tariffs and global competition. His comments come as Germany's parliament this week approved a reform of its debt brake proposed by Chancellor-in-Waiting Friedrich Merz.
If this reform makes
attractiveness is inherently a relative concept, and investors and the global capital that they represent have choices, and where they apply their capital ultimately expresses that choice of relative attractiveness. So I think what we've seen in the year-to-date period is clearly a compression in the US stock market, for example, and an increase in the indices that I look at for the European stock market. That tells you something.
According to a recent report from Morgan Stanley, European equities have this year outperformed US stocks by the widest margin since the year 2000. The MSCI Europe index has risen over 9% since January, beating the S&P slide of 4.5%. CEO Cesato also warned of a possible recession that could be triggered by the situation in US.
At the end of the day, the euro area has roughly 480 billion euros of goods exports to the US. Now, at the moment, the latest models that our research team have looked at are relatively mild in terms of the tariff assumption that's being made. But were there to be a 25% tariff on all of those goods, that could actually tip the Eurozone into recession.
Finally, on improving Europe's competitiveness, Barclays CEO highlighted the need for deeper capital pools, advocating to pair institutional firepower with private capital to address major challenges, noting that relying solely on retail investments would be insufficient.
$2 trillion to potentially